a coin shop in Florida, just made the single largest silver purchase in their history, $56,000. Over 700 ounces of physical metal walked out of a private collection and into a dealer's vault in one afternoon. And when I dug into the COMEX data to understand why transactions like this are accelerating right now, what I found made me stop and read the numbers 3 times. This is exactly the kind of information you will not find on mainstream financial media, and it is exactly why this channel exists. If you are not subscribed yet, do it right now, because what I am about to show you connects a small coin shop in Winter Haven, Florida, to a 79 million ounce crisis playing out on the world's largest silver exchange. And once you see the connection, you will never look at the silver price the same way again. Here is what happened. A private collector walked into a local coin shop with coolers and bags filled with silver eagles, silver rounds, graded coins, fractional silver, and 66 grams of gold. The shop owner tested every piece, weighed it, separated it, and over the course of nearly 2 hours, completed the buy. They paid spot-on silver eagles, which was $68 an ounce that day. They paid $3 back from spot-on generic rounds and $3 over spot-on all graded pieces. Total transaction, $56,225. But here is what caught my attention. The shop owner said something on camera that most people would have missed. He said, and I am paraphrasing, "Silver is kind of down right now, so I feel a lot more safe buying this much at these levels." Think about what that statement reveals. A dealer who does this every single day, who knows metal pricing inside and out, looked at silver at $68 and thought this is a buying opportunity, not a warning sign, not a reason to pull back, an opportunity. And when you understand the data I am about to show you, you will understand exactly why. Let me tell you what is actually happening underneath the paper price right now, because the numbers are extraordinary. COMEX registered silver inventory, the metal that is actually available for delivery against futures contracts, has dropped to approximately 79 million ounces. Let me say that again because it is important. 79 million ounces. That is the entire deliverable supply of silver sitting in the vaults of the most important commodities exchange in the Western world. Now here is where it gets uncomfortable. In the March delivery cycle alone, over 43 million ounces of silver have already been delivered. That is more than 54% of the entire registered inventory delivered in a single month. And the coverage ratio, which measures how much of the outstanding paper claims could actually be satisfied with real metal, has dropped to 13.5%. In plain language, for every 100 ounces of silver that exists on paper in the futures market, only about 13.5 ounces of actual physical metal sit in the vaults to back it up. The paper to physical leverage ratio has expanded to 7.4 to 1. That means there are 7.4 times more paper claims on silver than there is deliverable silver. If you have ever played musical chairs, you understand the problem. When the music stops, most players do not get a seat. Now I want you to think about something for a moment. If you own a share of a silver ETF, you own a paper claim. If you own a futures contract, you own a paper claim. If you own physical silver, an eagle, a round, a bar sitting in your safe or in your hand, you own the actual metal. And right now, the gap between those two things is wider than it has been in modern market history. The paper price says silver is $69, but physical dealers are paying spot or close to it because they cannot source enough metal to keep their shelves full. The spot price is crashing, but you cannot walk into most dealers and buy silver at spot. There is a premium. There is a wait. Sometimes there is nothing available at all. The price is crashing, but you cannot buy the product. That is not a market. That is a magic trick. And it is not just happening at one shop in Florida. If you like this kind of deep analysis, smash that like button right now because it tells the algorithm to show this video to more people who need to see it. Here is the broader picture. According to the Silver Institute, the global silver market is heading into its 6th consecutive year of supply deficit in 2026. The projected shortfall is 67 million ounces. That is 67 million ounces more demand than the entire world's mines, recyclers, and above-ground stocks can provide, and the cumulative deficit since 2021 now approaches 800 million ounces. To put that in perspective, global mine production is roughly 820 million ounces per year, so the total deficit accumulated over 6 years is nearly equivalent to an entire year of global mine production that simply does not exist anymore. It was consumed, it went into solar panels, it went into electric vehicle components, it went into 5G infrastructure and AI data center build-outs. And here is the critical part, that silver does not come back. A solar panel does not return its conductor at the end of its operating life. An EV battery requires disassembly and recycling with less than 30% recovery rates. This is not inventory being shuffled. This is inventory being permanently consumed. So why is the price going down? Because the paper market and the physical market are two entirely separate things right now. And that is not my opinion. That is mathematics. Drop the word disconnect in the comments if you see what is happening here, because I want to know how many of you understand this divergence. The January crash, when silver fell from its all-time high of $121 down to the 60s in less than a week, was not driven by a sudden change in silver fundamentals. It was driven by the nomination of Kevin Warsh as the next Federal Reserve Chair, which sent expectations for rate cuts to zero. Real Treasury yields spiked to 4.2%. The dollar surged, and then CME Group did what they always do when silver threatens to run. They raised margins multiple times. What happens when you raise margins on a leveraged market? You force liquidation. Traders who are long silver on leverage get margin called. They have to sell, not because they want to, not because the thesis changed, but because the exchange made it too expensive to hold the position. And when leveraged positions unwind in a thin market, the price overshoots to the downside. That is what happened in January. That is what continued in February and March. And that is exactly what creates the buying opportunity that every experienced precious metals investor recognizes. SP Angel Metals analyst Arthur Parrish said it clearly in his CNBC analysis just days ago. He identified a structural rotation underway. The Taurus, the momentum chasers, the hedge funds who piled in during silver's 135% rally in 2025, those are the ones leaving. That is the money exiting right now. But the core demand, the central banks, the industrial users, the physical accumulators, those buyers have not left. If anything, they have accelerated. JP Morgan shipped metal eastward at premiums of $10 an ounce or more above COMEX prices. Asian buyers absorbed both the premium and the import tax. They paid a premium on top of a premium because physical silver in hand was worth that much more to them than a paper promise. And this is where that $56,000 coin shop purchase connects to the global picture. That dealer in Florida is doing exactly what the biggest institutions in the world are doing, buying physical metal while the paper price is depressed. The only difference is scale. JP Morgan does it with millions of ounces. A coin shop does it with 700. But the thesis is identical. Physical reality always wins. The question is not if, the question is when. And for anyone sitting on the sidelines right now, this is not financial advice. I am sharing what the data shows, and every individual must assess their own circumstances, risk tolerance, and investment objectives. But I will say this, when a dealer who handles silver every single day looks at these prices and decides to write a $56,000 check, that tells you something about where they think the price is going. Share this video with one person who needs to understand what is happening in the physical silver market right now, because the mainstream financial channels are not covering this. Let me give you the numbers that matter for your decision making. Gold is trading at approximately $4,430 per ounce. Silver is at approximately $69.58. The gold to silver ratio sits at roughly 64 to 1. Now, historically, that ratio has traded as low as 15 to 1. Even if you use a conservative 50-to-1 ratio and gold stays where it is, silver would need to be at $88. If gold moves back toward 5,000 and the ratio compresses to 40-to-1, silver prices at $125. And if you go to the extreme historical compression of 15-to-1, which has happened before, you are looking at silver above $295 an ounce. This is not speculation, this is mathematics. The ratio is telling you that silver is undervalued relative to gold by almost any historical measure. Bank of America maintains a target range of $135 to $309. JP Morgan forecasts an average of $81 for 2026. Citigroup holds a second half target of $110. These are not fringe analysts. These are the largest financial institutions in the world. Now I want to close with something I think about every time I look at this data. There are three types of people watching this video right now. The first type is scared. They see silver down 44% from its all-time high and they think the bull market is over. They are selling into weakness, locking in losses, and they will look back at this moment in 12 months and wish they had not. The second type is confused. They see the price going down, but they hear about supply deficits and physical shortages and COMEX stress, and they do not know what to make of it. If that is you, go back and watch this video again. The data is clear. The paper market and the physical market are diverging. One of them is lying, and paper always loses that fight eventually. The third type understands exactly what is happening. They see the same data I just showed you. They understand that a coin shop writing a $56,000 check is not an act of recklessness. It is an act of positioning. They understand that when COMEX registered inventory drops to 79 million ounces with a coverage ratio of 13.5%, the floor under silver is being built by physical demand, not paper trading, and they are positioned accordingly. Which type are you? Tell me in the comments. And if you are not subscribed yet, hit that button and turn on the notification bell, because the next few months in the silver market are going to be unlike anything we have seen before. Every reference I cited is in the description below. I will see you in the next one.